Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, welcome back to the show.
Jim, pleasure to be back on the show.
John, the price of gold broke through $1,900 this week after Russia declared that the Donbas region of eastern Ukraine is now Russian territory. Generally, equity markets have been declining, but not collapsing. The resource juniors are not declining, but are also reluctant to move up. What's holding the resource juniors back?
Jim, the resource juniors market is waiting for the crucifixion of momentum gamblers to be over. The resource juniors themselves are not well suited for momentum gambling because their potential value is based on a fundamental outcome that's not open-ended. Now, in 2020, a sustained uptrend in the price of gold, it did draw momentum gambling into the resource juniors when gold breached $2,000 between May and September. But then when gold stalled, the momentum gamblers disappeared. By the end of the year, they were all into the spec tech stocks, these crazy meme stocks like GameStop, and of course Bitcoin was on a tear. Now the thing with these momentum type plays, you can't really calculate what the limit is. There's often a winner-take-all dynamic, which as long as it's going up, you can't predict what it will be worth at the end of the day. So the trend is your friend. Everybody's happy. Everybody's playing in this market. As long as it's trending up, it's fun. And why would you want to bet on a resource junior, which has to spend years sometimes pushing its project through an exploration cycle, waiting for news releases that allow everybody to get their pencil and paper out and calculate, what does this do to the fundamental outcome? The market that we've had was not interested in this kind. But we are at a bit of a turning point because January was a terrible month for the general markets, not as horrific as everybody has been expecting. But if you look at specific sectors like spec tech, that game is over. Even Bitcoin, it peaked at around 65,000 in November. Today, it's down 43% at 37,500 and even falling as we speak. And all those people that were sitting there on this wealth that had been magically created in the last 5 years are scratching their heads thinking, should we hang on, be hodlers? And then there's others who are thinking, we missed the boat the first time. The hodlers are all screaming, buy the dip to each other. And so we have suckers coming in, buying it. But the trend has been broken. And for a simple reason, Bitcoin doesn't refer to anything except itself. Now, in the case of gold, gold is stored energy, but Bitcoin is an energy liability. You can't trade it if energy isn't spent solving the equation that comes with in order to validate a transaction. And if the plug was pulled on every bit farm, all you would have left is a digital record in some physical hardware somewhere in the form of a wallet saying that you own so and so much Bitcoin. And if you imagine some dystopic future, treasure hunters digging in the ruins of a house, and they might find two objects. One might be a computer. They look closely at it on the hard disk. They can still access it and see it. And they may see a Bitcoin that's worth $37,000 today. They rummage around further and find a 20-ounce gold bar that's worth $37,000 today. Guess what they're going to put in their pocket and leave behind? Because gold is unique. You cannot clone it. And we're in a market now where the inflation argument is back on the table. It was 7.5% in January. To a large degree, it's been driven by supply chain problems and a surge in demand created by the rebound from the COVID pandemic and by all the money printing that was done to ease the burden of the pandemic mitigation measures. And the market's facing higher interest rates. The quantitative easing of the Federal Reserve, otherwise known as money printing, where they buy the bonds, and for freshly printed money, that will be coming to an end. Interest rates will be rising. They have to chill the demand that's driving this inflation, and that will involve a slowdown in the market. The higher interest rates are and the anticipation of them are what's killing the spec tech momentum game, where you're looking at the future growth of a company, imagining future cash flow, and comparing it to near zero or even negative interest rate yields. And all of a sudden, you're going to have much higher yields as the whole bond market normalizes to the higher rates of the past. So everybody's waiting for a big market haircut. There is the sector rotation happening, where they're going out of these spec stocks, and these growth stocks, and more into value stocks. And value stocks are relatively boring. So once this unfolds, the big markets will stabilize, maybe creep higher, but the momentum gain will be over. And that's where the resource juniors start to kick in, because there's always going to be gamblers, and the gamblers are going to start thinking in terms of fundamental outcome gambling. Now, the situation is complicated right now because Putin has invaded the eastern part of Ukraine. He's made it clear that he wants all of the Ukraine to be part of Russia. He has said he would like the Soviet Empire to be reconstituted, and he would like Eastern Europe to be under his thumb in the way that Belarus is now under its thumb. So this cannot end well. The West has to impose sanctions, and the sanctions themselves are going to impact food prices, because Russia is a major potash producer, and it's also an energy producer, which is used to make ammonia. And of course, as a natural gas and oil producer, if for whatever reason sanctions prevent Russia from delivering these raw materials to the world, you are going to see higher prices everywhere. So this inflation that will be chilled by higher interest rates is going to stay high, even as everybody starts cutting back on their demand, because you will see the supply withdrawn. So you started off with a demand upside shock, and then you cool that off, and then you deliver a supplied downside shock, and so you're still stuck with inflation. And that's the big markets are going to have trouble fighting that narrative. But for the resource sector, both in the precious metals and in the raw materials, this fragmentation of global supply as China and Russia square off against the West and globalized supply being disrupted, it's going to focus everybody's attention on developing supply closer to home, where it's not going to be subject to geopolitical machinations. And in the case of gold, this may be sort of a watershed moment where everybody realizes the United States, short of dropping a nuclear bomb on places like Russia, really can't do much to stop these local bullying that countries like China and Russia are doing in their neighborhoods. And as this world gets carved up into these different new regions, politically aligned regions, the U.S. dollar is not going to retain its status as the world's single reserve currency, and that's not going to change overnight. Hopefully it doesn't have to change, but there is now a reason to own gold, and we will see gold start to go through $2,000, hopefully not in a really rapid manner so that the momentum gamblers come back, but trending upwards and convincing this market that the longer-term price for gold is higher, as it is for most metals, and that betting on resource juniors, which are looking for these physical things in the ground and working to demonstrate that they're worth digging up and making available to the market, this makes sense. This is not going to have the rug pulled out from under us as it was at the end of the China supercycle, when the mining industry had finally woken up and then overbuilt, just as the demand growth, GDP growth flattened, and China also reached a plateau of more modest growth, and then everything was suddenly in a glut, and we ended up with lower prices, and that's what helped create our decade-long bear market that we are now at the end of. So watch for the momentum gamblers to disappear, but not all of them are going to be wiped out. Some will survive, some will unload their Bitcoin and their spec stocks and tech stocks and shift their money into this different fundamental outcome form of gambling for which the resource juniors are ideally suited.
John, one of your favorites, P2 Gold, published a resource update for its Gabbs copper gold project in Nevada. They plan to deliver a PEA by the end of the year. Last year, you visualized an outcome as to what the PEA might look like. How has the new resource update your outcome outlook for Gabbs?
Well, Jim, the P2 Gold and its Gabbs project is a good example of what I call fundamental outcome gambling. They acquired this project. Last year, it's had a lot of work done on it by various parties over the decades. It never quite reached the threshold of being worth developing. But in the context of stronger gold and copper prices, Ken McNaughton and Joe Ofsenek decided that we think this could actually work in the current environment. Not if copper goes back to $2 a pound or gold back to $1,200 an ounce. But if these levels that we have now are here to stay, this is going to work, and they're putting in money to demonstrate that the deposits, the various zones are bigger and better than they were assumed by the previous work. And they plan to deliver a preliminary economic assessment by the end of the year, along with a mine plan and ore schedule, which shows that, hey, this clears all the development threshold, the internal rate of return is good, and the after-tax net present value is significantly above the capital cost of putting this into production. So last year, I took that resource estimate that they had produced when they acquired the company, and this was all based on the historical work, and it was about 73 million tons. That was, averaged 0.26% copper and 0.53 gram per ton gold. And I looked at the size of the resource and the, 20,000 ton per day open pit mining scenario. And I put together numbers to a large degree borrowed from the company, which was in figuring out its cutoff grades for its resource estimate, had come up with mining costs, milling costs, leaching costs, and G&A, and they'd also figured out through metallurgical studies what their recoveries were going to be. So although we did not have a formal economic study presented by the company, there was enough information to visualize what this fundamental outcome could be. And when I did this and ran the numbers, it came in at about $335 million dollars US, which was lower than the $375 million capex. So that wasn't great. But the IRR was 19%. I'd like it to be a little higher. It was above that 15% threshold people want to see when they put up money to develop a mine. But it was clearly a work in progress, and the company's goal, they did drilling last year, was to build the resource higher. So the new resource, as a global, combined, indicated, inferred, and combining the oxide and the sulfide, it's up about 50% to 113 million tons. The only major negative thing about that is that the average gold grade declined 20% from 0.53 grams per ton to about 0.42 grams per ton. So, you get this press release and you wonder, what does it mean? But because I'd set up this model to visualize this fundamental outcome, I was able to put in all these new numbers and see what happens. And it did make it better. At the current metal prices, it cranks out at about 407 million US, which is better than the 375 million capex. Not super great. And the mine life goes from just over 10 years to almost 16 years. And you want to see at least 15-year mine life for a big open pit operation like this, because all the community, the other stakeholders that are around it, the ones that would like the jobs and an economy that evolves around the mine, want it to happen. They would like it to last a little longer than just a 10-year period. So this was a positive development, but not an earth-shattering development. They do have a 20,000-meter drill program underway now, where they are doing further infill drilling on the other zones. The drilling they did last year was on the Sullivan zone, and they will be drilling some of the holes will be deep enough to test a hypothesis they have that there may be a core to this that would be an underground block cavable situation, but could end up being a higher grade scenario. But in discussing with them, here's where the sort of simplified back of the napkin outcome visualization, such as I do, falls apart. They have an oxide cap to this deposit, which has a higher gold grade and a lower copper grade than the sulfide resource. And they want to heap leach this. And I've done a scenario where I've combined them, heap leaching and sulfide milling this deposit simultaneously, having the ore on the side. But when they get down to the PEA, you're going to see the heap leach scenario in the first 4 or 5 years deplete that 30 million ton heap leach cap first. And that means the capex associated with the mill, which is a big chunk of the cost, that will be deferred later. And the key to these outcome visualization, fundamental outcome gambling, is the discounted cash flow model, which underpins the valuation of every mine. So this cannot be done in a simple system. You need a spreadsheet. You need to fine-tune it and tweak it. And it's too early for an outsider like myself to try and guess what they are internally coming up with in terms of the best way to sequence the ore, when to phase in the capex for the mill construction and that. And that's going to be the big thing at the end of this year that we discover. And so with these numbers, I am quite happy, even though they're not fantastic and not a fantastic improvement. You know that the reality, when they properly optimize this, is going to be better, assuming the metal prices that we have, 450 copper and 1900 gold, are still the reality at the end of this year. In my view, I think the reality will be higher, but that's a different form of speculation. That's optionality speculation. And that's the other good thing about doing fundamental outcome gambling. When you do the numbers of crunching the size of the prize or the potential prize, you can also vary the future metal price to see what happens if we have $5 or $6 copper as the new long-term reality, or maybe $2,200, $2,500 gold. And I think as the momentum gamblers get cremated in what's happening right now in the general markets, we're going to see a small group of this crowd become fundamental outcome gamblers. And when that starts coming into the resource juniors, it's such a small space that the impact could be quite profound, especially when these people are coming in not because they're chasing things that are going up, but because they're understanding the underlying value concept.
Sonoro Gold was a Kaiser Research favorite last year, but today it is only Bottom-Fish Spec Value rated. What does it take to turn Sonoro back into a favorite for you?
Well, the big missing piece right now is the fact that they need to raise project financing and get the project permitted. They completed a PEA last year for the Cerro Caliche project in Mexico. For that one, that was another good example of fundamental outcome gambling. I had done an outcome visualization, imagining what the PEA would be like. Unfortunately, I was a little too optimistic in terms of the grade and the cost. So what they delivered last year was lower than I had expected. And of course, it's only about 6 years worth of mine life. Now, in 2020, when they got the ball rolling on this, they raised a lot of money with the dual idea of, let's do some core drilling to see if these low sulfidation epithermal vein systems here have some boiling zones that contain bonanza grade veins beneath the Buena Suerte and Japoneses zones where they had the obvious low grade disseminated mineralization at surface, and also do a lot of RC drilling and come up with at least 5 years worth of low-grade mineralization that we can put into production as a heap leach mine. And they decided that, yeah, we're going to do it at 15,000 tons per day to give it the scale, because when we do our geological assessment of the whole property, we know there's 1 million ounces here of these, 0.4 to 0.5 gram per ton grades. And we'll find the rest of it later. If we can get this thing started, then we'll have the cash flow, fund the exploration to look for the rest. And of course, once you're in production, then you benefit directly from a rising gold price. And the radical thing that they wanted to do, based on the experience of the people involved, the companies such as Jorge Diaz, was to put this into production simply based on the preliminary economic assessment, which still has 30-35% accuracy limitations. And last year they were quite optimistic about the permitting timeline. Now reality has descended upon them, and they figure, okay, all the environmental studies and everything, it'll be September when this is going to be when we'll have that permit. And right now they are looking at they're working with different potential sources of project financing that do not involve equity dilution. Now, the missing piece is this permit and this financing, but another missing piece is the fact that they have 120 million shares issued and 202 million fully diluted. They did another $3 million financing late last year. It ended up being lower than an earlier financing. That's a law, a rule that the market doesn't like broken. Namely, as you achieve something, you should finance at a higher price. But the reality was the market wasn't happy with the low grade. The outcome was was more than what the capex was going to be, and the IRR was okay, but the market didn't really like it. I did an outcome visualization where I extended the PEA numbers so that they had a 75 million ton resource rather than just a 32 million ton resource, and it comes out with sort of an $80 million NPV if they deliver this. But the market right now says, well, all you're going to be doing is infill drilling. You're not going to be really doing much to really expand this, and you don't need to, because those numbers farther down the road, they aren't worth as much as the upfront numbers. So in late December, they started a drill program, and it's targeted at the western trend, where only a small portion of it was included in the resource estimate that underpinned the PEA. And this is in the El Colorado area to the west, and it's south of the Guadalupe. And when you looked at the historical results, that was the part of the property that had the highest grades, but nothing had ever been done with it, and it was a little bit more hilly, and so access was not as great. But the mineralization, although you would get some good grades, it didn't really hang together. But as they were, developing roads last year to get access to the southern extension of the Japoneses and Buena Suerte zones, which have the bulk of the low-grade mineralization that will be heap leached, doing the roadside sampling, they were starting to come up with some interesting numbers, and they said, we're going to, instead of spending this drilling money trying to extend more low grade to the south, let's tackle this western trend of the Guadalupe, El Colorado, where we know there has been high grade, where only a fraction of it was included by the resource modelers and the resource estimate. And the goal there is to see if we can find some hot spots that hang together, that are higher grade, that are oxidized, that we can put into the heap leach at the beginning, because it's all about getting the cash flow early to achieve payback of the capital cost. And sometimes, people complain that, okay, if you're just high grading a system, you're destroying its future mineability. But if they find something in this Guadalupe, El Colorado trend, that is kind of separate west of the main area where they've designed all their, series of open pits. So hauling something out of there, it might destroy that if it's a lot more there than they thought when they hauled it out. But if there's simply, something richer and not super monstrous, that could make a big difference to the economics of this project. So it's a bottom fish now because I'm waiting for the permitting to be done. I'm waiting for them to secure project financing that isn't punitive. And I'm waiting to see if they can have some success with finding some higher grade zones that could be put into the early part of the ore schedule so that the economics improve. And of course, it's still an optionality play, because if gold charges to $2,300, $2,500, well, then the numbers at this 0.4 gram per ton grade, they really improve. And the challenge for the company is to get these 80 million or so, or 80 million warrants around 30 cents exercised sooner than later. They have several years of life, so they are an overhang. And this overhang is, in a sense, a negative, missing piece. It would be nice to get rid of this overhang, turn into money. It would raise $25 million, so that would take them a fair bit of the way towards the CapEx. So that's the challenge for this company. It's a bottom fish for now, but it could become a favorite again, especially if we do get a rising gold market later this year.
John, thank you so much for the update.
Jim, you're welcome.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.